Now remember, a gold-silver ratio upside move is actually bearish probably, and especially bearish for silver. Your question was, Francis, what does silver do next? It is a four-digit number, but our primary target is 333. I will sell silver for gold when we get a single digit. That means we break below 10. Failure to make a new low is actually quite positive. And what you also might start to get is a bit more compression because you're quite a lot lower on the high. So the silver, in spite of what sounds very negative, you might see a line here that goes like this. There is value buyers that are tactically retreating. They came in there, they came in there, and they're coming in there. Hey, if you're going to keep coming cheaper, we're accumulating. China had record imports of silver, by the way, benefiting from this discount window, as I'd like to call it. America has had record exports of gold to Switzerland and China over the last 5 months, which is the only reason they've not had record deficits. There is a gold-silver ratio set up that causes me some concern about being too aggressive right now. And this is what we're looking at. So currently, we're at the 63 gold-silver ratio level. Now, you might notice also that there's a 65.5 blue line that's driven through there. And I'm going to take you to a higher time frame to explain where that line comes from. There's not excessive amount of stuff on this chart, but there is that blue line looming. What's behind it all? So I'll just remove the volume by price for a second and just illustrate. We have in our methodology something we call key levels of significance. And this 65 level is a key level of significance. And you might say, well, why is that? And I'll answer that. You can see that you were resisted in the relative valuations of silver and gold in and around the 65 to 67.5 area. I always expect a key level to just be run and then a reaction. Just rerun, then a reaction. Then we went very low vol and we broke above. What then happened is you came back down, only this time you were supported up there and you went away. You had an extreme event where gold was deeply devalued. That was the CV19 spill that was very destructive to silver. And you had a big dip down, and where did you get defended?
If this holds above 63 for another month, silver holders could be walking straight into a hidden drawdown. The gold-silver ratio just rejected 65 twice in prior cycles before violent reversals, something Francis Hunt emphasizes when identifying key levels that institutions quietly defend. But here's the contradiction. Retail sees stability, while smart money watches for reversion spikes. That gap matters. For investors, this means chasing upside now risks entering just before a ratio-driven correction that punishes silver disproportionately. Next, Francis Hunt reveals why that 65 level isn't resistance. It's a trap.
Even though you ran on a spike quite a bit below 65, it's the 65 that got defended. Then we were in a holding box for quite an extended period. It was quite a boring era for the gold-silver move, and we actually popped out the top before we eventually broke out the bottom. At this point, we were calling the gold bull is definitely here, this box running, and we said we expect the key level of significance of 65.5 to fail and for gold and silver to continue to make very strong upside moves. Then we got our, call it our, it's not even halftime, but I know you have football, you have quarters. So first quarter break on the gridiron, and we got this rally up to here. Now I am looking at that and I'm taking you back down to that rally. So you now have the virtual context of what is looking here. Now remember, a gold-silver ratio upside move is actually bearish probably, and especially bearish for silver. Your question was, Francis, what does silver do next? And I'm saying to you, there is an either way move here, but my bias is we could actually have an upside move here, which could mean in a further extension sell-off on gold and silver, particularly with silver being higher beta, being worse served. And this gives a target around 79 to 80s level. So you could have a rally back above the 65 during a demand destroying event. 22nd of March would be the final low of gold, and you'll make only a localized low. And that we would see as very positive because it's currently in a bear phase.
This exact ratio setup appeared weeks before previous precious metals corrections, and the clock may already be ticking. A move towards 79 to 80 in the gold-silver ratio has historically coincided with liquidity stress events, something highlighted in Francis Hunt's timing framework. But here's the twist. Markets often rally briefly before that spike, luring late buyers. That timing deception matters. For portfolios, it means a short-term bounce could mask a deeper downside move, especially for silver's higher volatility profile. Next, Francis Hunt reveals the timing signal that precedes every major ratio spike.
Failure to make a new low is actually quite positive. And what you also might start to get is a bit more compression because you're quite a lot lower on the high. You only made our splitter. You might see a very faint line there. There's ones across the top, ones across the bottom, and there's one across the middle. You only made the halfway mark. When you start to get a lot of compression and selling across the top, and then you fail to make a new low, you actually get this descending triangle structure. What you mean is you start to get a bit of squeezing of the volatility. Here you had a massive expansion of the volatility, and even though this one wasn't as violent, it had two legs to it that was in percentage terms even larger. So what we will get is the sell-off spike will be becoming smaller and less violent, and in percentage terms less, and you'll fail to make a new low. That is the beginning of working your way up. Eventually, we want to see it break that capping line, but we might see good value in getting in earlier, somewhere in the after this target has been run over here, and enjoy a little bit of upside. This is for traders maybe, or even for long-term blue pot non-leveraged investors, getting in and enjoying some of that upside up here before the possible break over there.
Yeah.
So that was gold. I didn't answer your question on silver. May I bring the silver chart up for you to comment as well?
Okay, sure.
Again, I left that on Swiss francs. I'm going to bring it to dollars back so that everybody can understand the numbers. But you can see we are in that third sell-off, but not with the violence that associated what we call the slap in the face moments.
If volatility keeps compressing like this, most investors won't notice the setup until the move is already gone. Descending triangle formations with shrinking downside momentum often precede explosive breakouts. Francis Hunt's analysis suggests this is where smart capital begins accumulating quietly. But the contradiction is clear. Declining volatility feels safe, yet it often hides the most asymmetric entry points. For long-term holders, missing this phase means buying higher later or sitting through dead capital. The risk isn't loss, it's opportunity cost. Next, Francis Hunt exposes why low volatility phases are where wealth is actually built.
These two sell-offs, there was a little bit of it there, and then there was consistent, quite high volume into the low there. We still also, like you, we have two scenarios. My primary scenario thinks the March 22 low is our low, and that this is all part of a kind of falling wedge structure that is squeezing out, and that you're going to fail to make a new low here. I'm going to put it on the dollar because I need to bring everybody back into the room because people aren't familiar with the Swiss franc price of silver at all. But I just highlight we use multiple cross references when we do this. We forecast this quite a while ago. So I've got this bit of a bent banana thing going on here that suggested we were going to have this down leg when we were up top here, because we were in this channel. When you channel, it's a grind. That's what you're doing. When we expect a 3 sell-off leg, and we had already broken out of the falling wedge and we hadn't had the third selling leg. So we were saying, well, you are a falling wedge, but you're also getting a bit of a rounded bottom. That probably means there's still this third sell-off to come. That's now in play, even though you're out of the falling wedge. It can be categorized as a return move once you break the falling wedge, but typically we like to see 3 sell-offs inside the wedge.
High volume into lows isn't panic, it's positioning, and most investors misread that completely. The pattern of 3 sell-off legs inside wedges has historically marked institutional accumulation phases, something Francis Hunt highlights when mapping market structure. Yet public narratives call this weakness, while funds quietly build exposure. That contradiction matters. For your portfolio, this means what feels like the final shakeout could actually be the last accumulation window before trend reversal. Miss it and you're chasing. Next, Francis Hunt reveals how insiders use that third sell-off to transfer risk from strong hands to weak ones.
This one's occurred outside. Hence why we drew these lines showing that there's a little bit of a bend up. That too is bullish because it means the grind up took you right out of a very tightly squeezing structure. But it was a very tight squeezing structure because the tops were coming down very, very fast. So there's the falling wedge part of it that you broke out of over here. Now we took a little bit of a ride there. We didn't like the head and shoulder and we got out. Here's the head and shoulder on the lower time period that started the selling. And hence we've been waiting for this third sell. A little bit of a head and shoulder in there. You can see it. It did make its target. Let's just show you the head and shoulder. A little bit of a blow off top. There it is. And then you had a bad gap back down to the key level 78.6. You had that little squeeze over there that set up your right shoulder and you now ran that. And then gold broke down. So silver's now being brought down by gold. A little bit of a rising wedge coming down. So the silver, in spite of what sounds very negative, you might see a line here that goes like this. There is value buyers that are tactically retreating. They came in there, 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 and they're coming in there. So it isn't in a spill. We call that a basing descending grind line that shows, hey, if you're going to keep coming cheaper, we're accumulating.
Silver looks weak on the surface, but the buying behavior underneath tells a completely different story. Repeated bids at lower levels form a descending grind, which Francis Hunt's analysis identifies as stealth accumulation, not distribution. Yet the mainstream narrative frames this as breakdown risk, ignoring the consistent presence of value buyers. That contradiction matters. For investors, it means the market is quietly transferring supply from emotional sellers to patient accumulators. The real move builds in silence, not headlines. Next, Francis Hunt unravels why this weakness phase is where the next breakout is engineered.
Can I highlight that China had record imports of silver, by the way, benefiting from this discount window, as I'd like to call it. And America has had record exports of gold to Switzerland and China over the last 5 months, which is the only reason they've not had record deficits. Let me hand back to you.
So I understand that your long-term projections are quite lofty. I see the short-term projections, and there's some either way this can go over the next, we'll call it 1 to 2 months. But what are you looking at long-term or medium-term, for silver?
So the long-term, our dollar target price, where we will reduce some of our stake. It's not the top call. I will clarify that a little bit further. You will hit a dollar-based amount. I've on a point and figure chart that I'm working on, I have an even higher dollar price. I don't want to say it just yet. I don't believe in the whole Max Kaiser super hyping, but it is a 4-digit number. But our primary target is 333. I will sell silver for gold when we get a single digit. That means we break below 10 on the gold silver ratio. Unfortunately, that's not a dollar price. So it doesn't answer your question. The place where I can give you a dollar price is I will make mention that the HVF, the volatility funnel that you have set up here, I will draw for you.
The US is exporting record gold while telling you everything is stable. The contradiction should make you uncomfortable. Physical flows show China importing silver at record pace, while Western vaults quietly drain, a divergence Francis Hunt points to as evidence of silent redistribution. Yet the public narrative stays focused on price, not movement. That disconnect matters. For investors, it means the real signal is in who is accumulating, not what headlines say, and that window doesn't stay open long. Next, Francis Hunt unravels why global metal flows contradict the official strength narrative.
You just need to allow me a couple of seconds because I have to do one correction on it. So the high over here by data was not um, was not this number that's on this particular chart of Oanda. You actually traded a 50 during the Hunt brothers, and as a result of that, we need to it makes this secondary high higher than this one when in fact it wasn't that way. So we have what we call a data imperfection that I just do a quick correction for. So that's what all this monkey business is around. Luckily, our draw tool allows us to do that, and it will allow the draw. So the target of 333 is not something we've sucked out of our thumb. It comes from the geometry through HVF method that had occurred. And by the way, that gave us a squeeze within a squeeze over here that saw us saying at 25.9, you've begun the big run to 333. Our methodology has interim target levels where you're likely to slow down and have what we call progress decay, go sideways or down and make no new fresh progress to target for a period. It doesn't tell you how long that period is. We're on a very big chart. Each candle is a quarter, 3 months. You see it up top there. That was the highest point. We took out that piece of data to make that the highest point because of the data anomaly that I mentioned.
If your price targets rely on flawed historical data, your entire investment thesis could be off by years. The 1980s spike correction alone shifts long-term resistance geometry, something Francis Hahn recalibrates to avoid distorted projections. But here's the uncomfortable truth. Most models ignore these anomalies and still get used by institutions selling you fair value. That gap matters. For your portfolio, it means blindly trusting consensus targets could leave you underexposed before a major repricing event. Next, Francis Hunt reveals how one data correction rewrites the entire silver trajectory.
But actually we shouldn't. Our interim therefore should be a tiny bit higher. That there's a couple of targets at the interim level that were just inside the hundreds. We expected a pullback after silver ran the hundreds. That has occurred. It's part of the journey path before running the 330 stroke 333 adjusted level. That is the dollar target we have. We expect overperformance to that. The final sellout of my investment silver will be on a single digit gold silver ratio. A point and figure target that will give you more of a dollar number. And this is going to be more a statement about the dollar than silver, I hasten to add, has already given us a number of 2,210. I'm loath to talk that too much and try to be a headline grabber for those numbers. Point and figure is very accurate. HVF is the most accurate in geometry. So the 333 will be a pause area where you once again could have a candle like the shooting star over here and have a sustained period of non-progress before going higher. So targets again, to answer your question, 333.33. Pull back for an extended period, resumption higher, 2,210, and then single digit gold silver ratio. Those are my three periods, my three get out points, and where I expect pauses to occur in progress. You are currently in one now because you ran the 103, $105 level for our second interim, and that's why people are getting frustrated. Let me hand back.
If silver stalls after hitting triple digits, most investors will exit right before the real move begins. Markets historically pause after major psychological levels, but Francis Hunt's framework suggests these are consolidation phases, not tops. The contradiction is that frustration builds exactly when positioning should increase. That matters. For long-term holders, this phase determines whether you capture the move to 300 plus or get shaken out in sideways action that feels like failure. Patience becomes the edge, not prediction. Next, Francis Hunt exposes why these pauses are engineered to break investor conviction.
Well, that all makes sense. Okay, so what is I know you can't predict total timeframes, but do you have a bias that's leaning you towards for that 333 number? Is it 5 years, 10 years, 20 years? What is your bias pointing to?
So the amazing thing about HVF method is it even gives us time stops when we expect. that when we close our trades, due to the fact that even though they haven't stopped out or made target, they are now listing. Like listing is a word that's used for ships that have no wind. It's kind of just flopping around in the wind, and there's new forces that have negated that. So the HVF setup is known for performing well inside, often only utilizing 10% of the allowed time. So it's a real problem that we close immediately if you make a time stop. Just to give you an idea on that, the pattern on the primer triggered there and the main setup there, the allowed time to run through the $100 level was way out here at 2037. When did you actually make it? This year. So well ahead of schedule. And in the same way, the 330 target allows an excess of time. My personal expectation is you'll use about 10 to 15% of the time. And the other and key part that's informative about HVF method, and I'm going to just remove the log scaling for a second.
This move was projected to take until 2037, but it already happened, and that timing mismatch changes everything. When price targets are hit decades early, it signals acceleration cycles, something Francis Hunt identifies as a hallmark of late-stage monetary shifts. But here's the hidden risk. Faster moves compress decision windows. That matters. For investors, it means the next leg toward 300 plus could unfold far quicker than expected, leaving slow capital behind. Time is no longer your buffer, it's your constraint. Next, Francis Hunt reveals why compressed timelines signal systemic currency stress.
You should always have log scale on, but I just want to make one key point. For those that don't think it's a ballsy call, without the scaling of log, putting it into percentage terms, 333 is a huge call by reference. You are going to make way more money. And let me give you good news. Once you've finished dealing with the progress decay period of running a second interim, the open spaces, once you've left that 100 level, are typically covered in a very fast and aggressive breakout way. So we're talking about dollar capitulation and a whole new world society going on here when you run that. So be careful what you wish for, by the way, in this. You're going to be a winner on one hand, but who knows what our society is going to be looking like during this fiat basis and what governments are going to be doing to us for protecting ourselves. But this will happen briskly, considering how far it has to go from a number that's 70 to a number that's better part of almost $260 away. Before it rests again. So it will come fast when it's done and ready and starts again.
The Fed says inflation is under control, but exponential price projections in metals suggest something far more unstable beneath the surface. Log scale analysis shows moves from 70 to 330 are not gradual. They're regime shifts, something Francis Hunt frames as currency repricing events. Yet policymakers still project soft landings. The contradiction matters. For your portfolio, this isn't about gains. It's about surviving a rapid purchasing power collapse, where metals move faster than policy response. The breakout won't wait for confirmation.